Okay, greetings Mid-Plains Ag and greetings from AgResource Company in Chicago. It's nice to be here again for our second webinar. And in this one, we will discuss the USDA's May Supply and Demand Report, which of course is the first that features new crop US and global supply and demand estimates. And also this is all occurring in the era of COVID-19. We think that this probably has some long-lasting implications. We're seeing some recovery of the economy in the US and elsewhere, but it's going to be very slow and fragile. And so what does that mean to the ag space moving forward? And so this is another bearish outlook, but we want you to be aware of this because it will be important during the summer months as we get into the growing season to sell rallies. And I'm going to spend the next 20 minutes or so telling you why that's the case. So if we get into the major themes, they are still the lack of miles being driven and a near complete shutdown of restaurants and food service industries. And so we think that this will improve on the margin somewhat, but a lot of things have just been postponed or canceled. You know, major sporting events, sporting seasons as a whole are uncertain. And so that should, on the margin again, reduce total food demand in 2020 and into 2021. The ethanol industry, as of last week, was still operating at just 60% of capacity. And we're hearing that plants await new crop harvest, perhaps, before really returning to normal. There is some return of plants in the eastern Midwest where margins are turning profitable, but elsewhere they are still negative. And so the ethanol industry will struggle to grow over the next 3 months. The USDA report by itself also confirms again that widespread adverse weather is needed in the US and elsewhere to attract the fund and money back into the ag space. So once again, to turn bullish, it's up to Mother Nature. And global financial woes are still forthcoming. You know, even as we are using more gasoline and driving a little bit more in the last 4 weeks, unemployment is rising here and everywhere. You know, reports show that there are 122 million people unemployed in India, and so this will have global, far-reaching, and lasting impacts on food demand longer term. And because of this, South American currencies are again record low. Major grain importing currencies are also low, and so the purchasing power has been significantly impacted. Acreage will continue to expand in South America and in the Black Sea because of this. And the economic weakness that we're seeing now will only exacerbate farmer profitability in emerging markets. And what will normal activity look like? You know, a lot of people are just simply awaiting for the virus to end entirely or for a vaccine to really get life back to normal. And our job as analysts now is to predict how many people does that encompass. You know, so will we get back to 90% of miles driven in 6 months or 85%? But there's going to be some segment of the population that simply waits on a vaccine before getting back to normal. And so we know now, because corn stocks are swelling globally, soybean stocks are declining. The goal in the next 4 or 5 months is to shift acres from corn to soybeans and wheat and barley and oats and even lesser markets by early 2021. So there are still these broad deflationary trends intact. This shows the broad basket of commodities since May 2018. Clearly, there's been a lot of weakness recently. And we've consolidated since then, but we're generally, as the world is waiting on some spark to resume some kind of uptrend line. And that probably doesn't happen in the foreseeable future, at least over the next quarter. We think that this commodity index just trades sideways for the next several weeks. Part of that is because of grain oversupply, energy oversupply. The USDA's May WASDE estimated global major crop stocks at a record high 750 million tons. This is up 38 million tons from the previous year. Stocks to use is estimated at 33%, second highest on record, and generally very large. And I think what this graphic shows is there's clear definition or division between pre-2012 and post-2012. So even during 2012, global major crop stocks were pretty normal. Stocks to use in the years previous to that, 20 to 22%. And that was the way the world ag space was. But since then, we've attracted new acres in Brazil and Argentina and in Ukraine and Russia. Currencies have only exacerbated that, so they continue to expand, and we're left with this, major change in supply. We have just too much of everything at the moment. A lot of this in 2020 will be due to massively higher global corn stocks, But in the future years, we think we'll just shift that around. So we will grow less corn in 2021, but probably more beans and more wheat. And so the total number of tons in terms of global stocks will be unchanged. It's just the pieces of the pie will be shifted around. And that's the concern longer term. And the same is true in the United States. The major crop stocks in the US are estimated at 120 million tons. Stocks to use, 22%. All of this is very large and kind of bearish longer term. And again, we show this pre-2012 and post-2012 landscape. Because we've lost world market share in terms of exports, we've just been allowed to build combined stocks in nearly every year since. This has only been disrupted temporarily by adverse weather in 2019. But you can see that if the markets rally because of adverse weather, we only plant more and produce more of commodities the following year. And so like in the world, this will change. Corn stocks next year will fall, soybean stocks will grow, and will we be left with 120 million tons of major crop stocks in 2021? And our bet is that we will, unless Mother Nature intervenes. And so a quick analysis of the updated U.S. corn balance sheet. So the USDA, pretty much as expected, placed new crop corn ending stocks at 3.3 billion bushels with the stocks to use at 22%. Both are the highest since the mid-80s. We think that these numbers will rise further still because the USDA has taken a pretty measured approach in lowering ethanol's demand draw. We think that ethanol's demand draw ultimately will be lowered another 400 to 500 million bushels, simply because the pace of weekly ethanol production is just so far off the pace that's needed to meet the USDA's forecast. These numbers will be fluid. Ethanol production does rise in the weeks ahead, but it won't happen fast or as intensely enough to change or to validate the USDA's forecast. So our higher old crop stocks spill into new crop, and we think we'll be left with 3.5 billion bushels in 2020-21. Stocks to use approaching 24%. So clearly moving forward, we need less corn or more demand or a weather problem. If it's not a weather problem, the market has to signal the need for lower acres via a lasting period of depressed prices. The loosening U.S. corn balance sheet also is spilled into the major exporter corn balance sheet. Major exporter corn stocks, this includes Ukraine, South Africa, Brazil, Argentina, and Russia, will reach a record 100 million tons in 2020 with normal weather. So that just means there will be steep competition for exports. Everyone wants that piece of pie in South Asia, East Asia, Southeast Asia, but we have to compete with Ukraine, now even Russia, to get that demand. And that means that prices will be fairly weak for a long period of time, and rallies will be met by competition. So if our prices rally in the U.S., Russian corn prices will undercut us, and then they'll get the demand, and so on. So that's the broad theme of corn over the next 6 or 8 months. There's just too much of it. Exporters will be vying aggressively for market share. And this is what this looks like historically. So 17% stocks to use is up sharply from last year and actually is the highest since 2004. We think, again, this number grows as the U.S. corn balance sheet loosens, but it tells the same story, is that there's too much and we need fewer bushels of corn in exportable positions by 2021. However, the U.S. soybean balance sheet looks at least less bearish. We think that the old crop U.S. soybean stocks will rise, not because of biofuel issues, but because of export issues. The pace of exports to China, which has improved in the last couple of weeks, is still way below what it needs to be to validate the USDA's forecast. So we think exports will ultimately be 50 million bushels below the USDA. This will be added to stocks, will spill into implied new crop supply and demand, and we'll be left with not an overabundance of soybeans, but certainly adequate. However, the soybean balance sheet will be more sensitive to weather, as in stocks reflect about 7 or 8 bushels of yield. And so unlike corn can lose up to 5 or 7 bushels of yield from trend, and we're still left with too much. Soybean market can't really afford that, or nearly to that extent. So if we lose 2 or 3 bushels of yield on soybeans, then the balance sheet all of a sudden gets very tight. And so we expect the soybean market, more than corn, to react to summer weather issues over the next 90 days. The major exporter soybean balance sheet, combined U.S., Brazil, and Argentina, also tightens by 4 million tons, even with normal weather. and expanded acres. So again, like in the US, South American weather needs to be very good to prevent, somewhat bullish outlook for soybeans into early 2021. So these two markets look very, very different. This is what exporter soy stocks look like historically. You can see that we've contracted pretty significantly over the last 2 years. Part of that is weather issues in the US last year, issues in South America the year before that, but it's also due to stable and now rising global demand for oilseeds. The pace of Chinese soybean imports from all origins, mostly from Brazil, has been pretty incredible over the last 2 months. And the USDA forecasts China's imports to be 96 million tons in 2020, and so record large and back to pre-trade war levels. Though, remember, China in 2018, before the trade war began, was forecast to import 104 million tons, so there still has been net demand destruction based on the trade war. But still, it's important to recognize that China will import a record amount of soybeans in 2020, and our contacts in China do kind of validate this. And in fact, 2019 exports might be 1 or 2 million tons, understated still. So China is back in the world soybean market, and that's important. And we think China will be very active in securing U.S. soybeans for September to December arrival. Restaurant traffic is at the very least not zero. It's hard to see, so I've highlighted it with this blue circle, but you can see we're only down 97% in the United States as a whole year over year, compared to down 100% as of May 3rd. So as select states begin to reopen, we are seeing traffic increase on the margin, but you can also tell that there's a long ways to go. And the issue over the next 30, 60 days is that major population centers like LA, Chicago, New York will probably keep some measure of lockdown orders in place into the middle part of summer. So there's just a lot of people that eat at a lot of restaurants in those population centers. And that has a pretty big impact on total food service demand in the United States. So it's good and bad. We are bouncing off the bottom, but it will be very, very slow. This shows the year-over-year change in sit-down traffic in the states that have reopened. Now keep in mind, this is not really a measure of growth, but just the lack of negativity. So Arizona, for example, instead of being completely shut down, is now down only 77% from last year. Places like Nevada are down only 84% from last year. But we are seeing, as these regional economies begin to relax restrictions, people have been responding by going out to eat. So that's important. But we're still not there yet. Not the real get up and go that we'd like to see to be outright bullish commodities. We follow weekly dairy sales and prices as some kind of indicator of future restaurant demand. And you can see that as of the early part of May, the volume of cheddar sales was down sharply from recent years. And importantly, the prices are also down. So we've gone from $1.64 for a 40-pound block in mid-April to $1.13 per pound last week. Lower sales, lower prices is a clear definition of weak demand and demand destruction. So we're not quite to the point where markets have that get up and go and the all clear signal that the economy is ready to reopen as a whole. But there are certain places in the economy that have been doing much better. So this is another indicator we think of, marginal weekly changes in economic activity. Weekly motor gasoline consumption has rallied from 5 million barrels per day during the lulls of early April to 7.5 million barrels per day last week. So we're still not close yet to recent year levels. We're still down about 20%. But the change and the speed of the change is interesting. And so as we've used more gasoline, ethanol stocks have been contracting fairly quickly. So the ethanol industry is still very, very slow to recover. We don't expect a major change in the next 2 or 3 weeks. But you can kind of extrapolate at some point, stocks will fall to last year or below last year's levels. At that point, does the ethanol market need to signal the need for more supply via profitable margins? This will all be very precarious. We'll be monitoring weekly gasoline consumption with incredible interest. But we need to make sure that these economies avoid high reinfection rates. But that's on the margin, things are looking somewhat positive for the biofuel and energy markets. You can see we can extrapolate miles driven more or less. So in early April, miles driven was down to 4 million miles per day. This is much different than it was in all years previously, but we've cut that difference in about half. in the 30 days after it. Futures-based ethanol margins have crawled back to above break-even basis spot, but are still negative in deferred positions. But still, this is all very regional. There are places in the eastern Midwest where even the cash production margin is positive. Out west, cash production margin is still negative. But we should see, incremental changes, boosts in ethanol production moving forward. Because so far the recovery has been pretty limited. Despite higher gasoline consumption, declining ethanol stocks, the industry as a whole has not gotten the signal to really turn the spigot back on. And so what's interesting about this and why we are so still bearish old crop corn supply and demand is last week we produced 175 million gallons of ethanol. To meet the USDA's forecast, by June 1st, this number needs to get to 275 million gallons. There's still a pretty arduous chore ahead if the USDA's old crop corn balance sheet is to be validated. And this is shown on a monthly basis here. So we plunged in April. Our forecast for May official US ethanol production is slightly higher, but we need to average, beginning in June, 420 million barrels per month to meet the USDA's old crop corn ethanol demand draw number. This is not too far off from the levels of recent years. And so we just think that this is highly unlikely. We do think June, July, August ethanol production goes up from current levels, but not nearly to the point where we'll use 4.9 billion bushels. We think we'll use 4.5 to 4.6 billion bushels of corn in an old crop position to produce ethanol. And it's not just miles driven. One big issue too is that Brazilian ethanol has plunged as well. Brazilian ethanol in Sao Paulo today is cheaper than ethanol at the US Gulf. And so we've lost a pretty major market for our ethanol exports. And it doesn't really show much here, but our total corn use for ethanol is a function of gasoline demand, and so miles driven, as well as straight ethanol exports. It's shown a little more clearly here. And so the difference between 2016 exports and 2018 exports works out to about 140 million bushels of corn. And so 2020 exports will be down sharply. And so even if we are to normalize or get close to normal in terms of gasoline consumption, what will the ethanol export number be? We think we need to get back to something like record ethanol exports if ethanol's demand draw is to reach 5.4, 5.5 billion bushels in the next 1 or 2 years. So again, just highlights the difficult chore that's ahead for energy and ethanol markets, and thus the corn balance sheet moving forward. We also still have yet to deal with the full ramifications of negative GDP growth in 2020. This slide shows the IMF's data and forecast. The black line represents the forecast for 2020 and 2021 made in October. The red line shows the IMF's update made this April, which fully accounted for the spread of COVID-19. So what's interesting about this is, in all their wisdom, the IMF thinks that GDP will perform more poorly than it did worldwide than in the 2009 recession. So this is significant. So even as restaurants open and people start to drive again, disposable income will be down across the world, and so the frequency of vacations, restaurant trips, will be much lower than it was pre-COVID-19. There is sort of this forecast for a surge in economic activity in 2021, assuming COVID-19 is contained or a vaccine is available. And the snapback and return of inflation is fairly common in years of recessions and depressions. But a lot of this hinges upon how we handle and contain the spread of this virus in the very near term. So we'll all be watching the reinfection rates in those places that have reopened their economies with, again, incredible interest. We need to make sure that infection rates do not return like they did before. And the fall flu season, fall and winter flu season, we need to make sure that the virus is contained during that period before we have some return of economic growth and inflation next year. And in the very near term, unemployment falls 21 million in April. So we'll be dealing with massive unemployment for the foreseeable future in the United States. And again, why that matters to us is this all reflects disposable income, trips to restaurants, types of food eaten. And so we think that this will be something that is not overcome very quickly. Gasoline consumption will continue to rise, But does it plateau at something like 85, 90% of normal and stays there for 4 to 6 months? That's the big concern longer term. And so we've got demand destruction on one side, lack of economic activity, terrible ethanol margins. We also don't see much in the way of threats to trend yields in the US and across the Northern Hemisphere in 2020 just yet. And a lot of these crops are still in the bag, and so it's premature to kill a crop for sure. But even based on planting dates, which don't precisely forecast yield, we can see that there is a very broad relationship. When the US corn crop is 65% planted on May 15th, the odds are very high that yield will be above trend, and vice versa. And so we think that on the day of May 15th, we should be 75 to 80% planted. And so we probably are in the quadrant that gives us trend or above trend yields, or at least a high probability of that occurring. Early season crop ratings, which have been released for 2 weeks across the Delta and Southeast, have centered on about 70 to 72% good excellent. And that includes Louisiana, Mississippi, and Arkansas. And they've weathered excessive rainfall pretty well. So we think that foreshadows pretty high national corn good to excellent ratings, which should be released the day after Memorial Day. We also wonder if oat ratings, which were officially published last week, also foreshadow some kind of really high initial corn rating. So on a nationwide basis, the oat crop was rated at 69% good to excellent versus 58% the year before. Oats in Iowa are rated 79% good to excellent versus 66% the year before. And so the oat belt does sort of overlap a lot of the northern corn belt. And so we figure growing conditions are more or less the same. And so again, we're expecting the season's first corn crop rating to be between 70 and 75% to good excellent. And that's a bit above average. And though we don't have much confidence in weather forecasts beyond 10 days, it's equally hard to define a model or a map that shows some kind of glaring threat, at least in the near term. This is NOAA's CFS model's forecast of temperature and precipitation anomalies for the month of June. These will be changing on a daily basis, but the probability of heat and dryness is much lower than normal. So what that means is to turn bullish of agriculture or crops, we need supply dislocation. But now we think that probably falls solely upon pollination and blooming periods. And so really, if Mother Nature is to give us a rally, that probably doesn't occur until the second half of summer. And planting dates too probably suggest that a lot of the corn crop will pollinate in the first half of July, which on the margin is a little cooler than the second half of July on average. We are watching EU and Black Sea dryness as it pertains to wheat yields, but wheat and corn are grown in very different places in Europe and the Black Sea. And so the red circles on this slide highlight the major corn producing areas in Europe and the Black Sea, and that includes southwest France, Romania, and the northern half of Ukraine. Dryness in Romania, we do see that, but otherwise, southwest France, Ukraine, which will be a sizable exporter in 2020, have seen it well above normal rainfall in the last 30 days. Crops there have also been planted, like in the US, faster than average, and we think as of this weekend, crops really across the European continent should be about 75% seeded, which is about 10 points better than normal. And while the U.S. corn balance sheet is really responsible for the swelling of global supply, it's not entirely responsible. So we are seeing stocks building in other places, including Argentina, Russia, and Ukraine. And when we exclude the U.S. from the major exporter corn balance sheet, we're still seeing production at a record high 224 million tons, and that's up 7 million tons from last year. So combined production in Russia and Ukraine, Brazil, Argentina, and South Africa will be a record level. And again, this just underscores that export demand will be fought over in a way that we haven't seen for a long time. This will pressure bases at the Gulf, bases at Argentina. Anytime Gulf corn rallies too much, Ukraine will be there to undercut us. There's just going to be a real steep fight for demand, and demand is growing, just at a normal 2% per year. And so that's what's going to keep us in this steady to lower price trend, throughout the next 6 months. Mother Nature has to be the one to change this around. And longer term, we still have lost the mechanism that corrects oversupply. So usually we have oversupply, prices fall, production falls. But because currencies in South America are so weak, and their markets still are based on Chicago Board of Trade prices, growing corn and soybeans in Brazil and Argentina is still highly profitable. Input costs are going up, and that might eat into margins a little bit. But in talking to CONAB, the USDA's equivalent in Brazil, they still expect major acreage expansions over the next 2 years. In fact, I think farmers in Brazil have already sold half of their projected soybean crop that they will plant this October. It's just very, very attractive to be a farmer in South America. And so while those currencies are stimulating production, weak currencies in major importing countries are on the margin lowering those countries' purchasing power. And so we think there might be financing difficulties in the next 6 or 8 months. These are major wheat importing currencies, but Turkey and Algeria are also major buyers of corn. So we can see that Algeria's currency is down 15% from last May. And that's mostly because of crude oil prices. So a lot of these importing countries in North Africa and the Mideast do their annual budgets based on $40 to $50 crude oil. But today crude oil is at $30 a barrel. And so we think that they'll be less willing to chase rallies, and overall demand for wheat and corn might be down slightly in 2020. So all of this reflects financial weakness, global unemployment, just sort of the catastrophe that's happened based on the spread of COVID-19. And as an example, this just shows you what currencies do to prices in different countries. So the price of corn at the Chicago Board of Trade is down 25% from last May. That is not insightful. But when pricing the Board of Trade corn in pesos and Brazilian reals, those prices are up 15% from last year. So despite 4-year low prices of corn in the US, there's still profitability to be had in South America. And so they're going to keep expanding and adding to this already oversupplied marketplace. And so finally, we look at what has to happen. So we will assume the USDA's balance sheet and not our balance sheet, but in order for supply and demand to be better balanced longer term, we think that we need to lose some 12 or 14 million acres of corn in 2021. And this will be taken care of through spreads, wheat and soybeans premium to corn, which will widen over time. But only once we cut acres by 12 or 14 million can we talk about the return of $3.80 to $4 corn again. Maybe $4.40 if there are weather issues. But none of that is on the table until 2021 at the earliest. And so again, how do we cut acres so much? Corn has to be and stay very weak relative to other commodities. Flat price has to be weak. We have to stop incentivizing corn production, and that happens through low prices. And so I know this is all very much doom and gloom, but we want the producers in the U.S. to recognize this and come up with a strategy. Selling rallies, even these Chinese demand-based rallies, which in the last couple of weeks have been 5 or 7 cents. Even those are an opportunity to catch up on hedges, maybe add to sales. I think the market will struggle above 340 basis December corn. 380 2021 corn is probably a place to start hedging 2021 crops. So it's just important to be proactive in managing this, because we do think that supplies continue to grow as future USDA reports are released. And we do look for net weakness in corn prices, and probably wheat and soybeans between now and late August, early September. And so I thank you for your time, and thanks for having me, Mid-Plains. And if you have any questions at any point in the future, please reach out to us. And also, if you need help marketing your grain, we're here to help and discuss strategy. So please don't hesitate to get in touch with us if you have questions about anything. Thank you very much.
Yeah. So Ben, I've got a few questions to follow up on here.
Yeah, go ahead, Rich.
Okay. Could you comment on basis levels across the Corn Belt? I know here after the ethanol industry shut down, we went from 500 to 40 under. How was that across the Corn Belt?
It's been really impacted, and ethanol has had a big part of this. But it's really been the separation from east to west, and that's not news. But we still look at basis in Indiana, Ohio, and Kentucky, 10 to 25 cents over, and based on regional supply and demand tightness. So imagine we don't reach equilibrium, but there's probably not a lot of downside risk in Western Plains corn basis, and there probably is 30 to 40 cents of downside risk in the Eastern Corn Belt. And even looking at new crop offers in the East, they're pretty commonly 20 to 30 cents below December future. So that all corrects itself pretty quick. Because, the regional supply and demand, if you were to group Indiana, Ohio, Kentucky together, for example, it was pretty tight this year, but it will be very, very loose in 2020 unless there's just, major yield loss. So I wouldn't be anxious to sell basis in the West, but, if you do get it up 10, 20 cents, probably the spot to get it done.
Yeah. Hey, most of the farmers out here probably signed up for PLC this year. And that's based on the national cash price for the year. Where do you anticipate cash price for the 19 crop to be for?
So we see it probably falling to something like 330 or 335, or let's call it 330 to 340. One of the issues is how that's calculated. So, it's weighted by, each sale. We'd say probably 70% of the U.S. corn crop is sold between September and December. And so it doesn't fall all that much, or it won't really reflect today's cash prices, just because there was strong basis in the East. And just a lot of that calculation has already been done. So, the weight of current cash prices is much less than was, the impact of cash prices in October across the U.S. But it does get weaker, no doubt.
Okay. What about the prices over the next, say, between now and September? How do you see them going, and where do you see the fall lows coming in at?
So again, we're looking for net weakness, of course, but the way we think this all happens is, we get the corn planted in the next 10, 12 days. We'll have early season crop ratings that are better than average. It could be much better than average. And at that point, we probably do find some kind of intermediate low. Maybe that's 320, 315 December, Chicago. And then we just wait and see. We need to better understand the U.S. climate forecast. Crops are rated very highly in 2012 as well, so anything is possible. But assuming normal weather, we probably stay neutral through the summer, and then like the last 4 years, just the weight of those final old crop sales in late August, early September will give us our ultimate low, which probably will be a decade low. We model it out to something like 820 November beans and 280 to 290 December corn. And then it's just kind of tough to be bearish. I think we just probably trade sideways thereafter for a long time and looking at South American weather. But it will be tough to be bearish, sub $3 December corn.
Okay. You mentioned an 820 low for soybeans this fall. Where would you hedge soybeans at between now and then?
I think we'll have opportunities. Again, I mentioned that the soybean market will be much more sensitive to growing conditions. And so we think there is potential to see, 860, 875 November beans. I just don't know if we can get much above that unless there's a South American weather problem. And that won't happen until January. So anything above 870, we will be pretty active in adding to or catching up on hedges.
Okay. If anybody has any further questions, you can email Ben at the email address on the screen, or you can get a hold of us at Mid-Plains Ag. We will be posting this video on our website here as soon as possible. So again, I'd like to thank Ben, and we hope everybody finds these recordings useful. If you got any comments, please, on how we handle this, please let us know. Again, thanks, Ben.
Thanks, Rich. Everyone have a nice day.
Yeah, thank you.